Hello, everybody. We are just give it a few minutes to start our webinar, just to let people kind of filter in and trickle in, and we will get started now. And thank you, everyone, for joining our webinar hosted by GHJ and along with Griffin Capital and Baker McKenzie. And then we'll go through a quick kind of intro, and then a couple housekeeping items before we get going. There is going to be a Q&A function in the Zoom chat. If you have any questions, just submit it there, and then we'll kind of filter and then collect it. And please send it there so that we have a log of all the questions, and then we can try that. We'll have some time at the end of the presentation to go through it and hopefully have some time to answer all these questions. So next slide, please. So just a quick intro. So our agenda was in the invitation, and today we have myself, Richard Wu with Hasson Janks. I'm a principal with the firm in the tax department. My experience is mostly in real estate. Spent quite a few years downtown at one of the big four accounting firms, and that's where I got most of my real estate experience. I had a lot of REIT transactions there, partnerships as well. And at Hasson Janks, I do, along with the rest of the partners, I do a lot of real estate clients here. And then we have Kevin Shields, Chairman and Chief Executive Officer of Griffin Capital Company, and Randy Anderson, President of Griffin Capital Asset Management. Griffin Capital is a alternative private asset manager specializing in innovative real estate investment solutions. And then we have Daniel Cullen, a partner with Baker McKenzie, a law firm. Their firm specializes in real estate transactions as well, and unique legal structures and their investment vehicles. And at this time, I'm going to go ahead and just turn it over briefly to Kevin. I wanted you to start and just give a quick background about yourself, and then we'll get going into the rest of the presentation.
All right. Thank you, Richard. I appreciate everybody joining us. As Richard indicated, I'm the Chairman and Chief Executive Officer of Griffin Capital. Griffin Capital is a firm we started in 1995. We've got about 15 or 16 billion of assets under management across our platform. We operate really in three different verticals. We have two public non-traded real estate investment trusts, one that focuses on long-term single-tenant net lease office and industrial assets with about 4.7 billion of property. We have a medical real estate REIT that's got about 4.2 billion of medical office, skilled nursing, assisted living, and hospitals. We have a series of private credit solutions. We just getting ready to close off a qualified opportunity zone fund, which is focused on 9 ground-up multifamily developments. We raised about $460 million over the last year to facilitate $1 billion worth of development. We bring to market on an occasional basis single assets, core multifamily that we wrap into a Delaware statutory trust, the beneficial interest of which qualifies like-kind property for purpose of a 1031 exchange. We've got some other discrete development opportunities that we bring to market periodically. And then in the middle of the plate is Randy's world, which is our interval fund complex. So Randy is the CEO of Griffin Capital Asset Management Company and really runs our interval fund complex, which is comprised of the Griffin Institutional Access Real Estate Fund, which has got just over 4 billion of equity, as a diversified and actively managed book of public and private real estate securities. And then we have a private credit solution in partnership with Bain Capital Credit, which has got about $500 million of equity that focuses on high yield corporate, everything from liquid high yield to structured credit, CLO, debt and equity, direct originated middle market loans, which is the province of BDC, all the way through special situations, including distressed and European non-performing loans. And then wrapping it up all together is our securities company, Griffin Capital Securities. We've got about 100 people focused on deploying and raising capital that we ultimately deploy across our platform. We've raised about $15 billion of equity capital, all in the retail space through the 3 principal channels, the independent broker-dealer channel, the registered investment advisor channel, as well as the wirehouse channel.
Thank you, Kevin. And then Randy, do you want to just jump in and quickly add anything if you?
Yeah, sure. Kevin did a great job. I came to Griffin about 6.5, 7 years ago to start up the interval fund complex. We've had a lot of great success. Been delighted to be part of Griffin Capital over this time period. One of the things I guess will help with my role on this panel is I've spent most of my adult career somehow thinking about real estate and mixed asset portfolios. I like to say I'm a recovering academic. I used to edit the Journal of Real Estate Portfolio Management, and the whole thesis there originally was, you want real estate in your portfolio? And once you got back sort of past that and everybody sort of agreed yes, The next question is, how do you best sort of construct real estate portfolios to optimize the risk-adjusted returns? And from that experience, I also was head of research or chief economist for several large institutional firms. So today I get the pleasure of being with two great panel members and talking a little bit about the national real estate market. And one of the things that I'll just give you a little preview is that one of the things that have been closed in Manhattan Beach for a long time is hair salons, and therefore you have what you're looking at today. So anyway, thanks for joining us today.
Thank you, Randy. And then last but not least, Daniel Cullen of Baker McKenzie.
No, I'm thrilled to be here today. I've had the fortune over the last over a decade now to work with Griffin Capital on several projects, and I've always appreciated their carefulness and the approach to which they bring investment offerings to the marketplace. I am a partner and chair of the tax practice group in the Chicago office of Baker McKenzie, and have spent over 20 years helping clients build real estate capital market structures and address the related securities issues surrounding them.
Thank you, Daniel. And then just so everybody knows, everyone will be getting the slide deck. So there's a lot more information about GHJ, about Griffin Capital, as well as Baker McKenzie in the back slide. So you'll get more detail in that as well. And then we'll go on to the next slide, please. So here's a brief agenda. We did the intro and then of the speakers, and then we'll kind of talk about the real estate market outlook, and then the current political environment, and then investment opportunities. And then finally, we'll end it with some transaction structuring or investment vehicles that can be contemplated. So the purpose of today's conference, really, the webinar, is to provide all you attendees with information regarding real estate investments, whether it's looking at, and it's going to be more forward-looking. So if you can go to the next slide, please. So at GHJ, we've been pioneering what we call a business resiliency journey model. What that is really is just kind of what we've seen the overall economy kind of moving in kind of it's not so much linear, but it is, if you draw it out in a line, we have it kind of broken down into 3 phases. Next slide, please. And the first phase is going to be respond, which a lot of the clients and companies of all industries were dealing with as the COVID hit and pandemic shut down in mid-March, right? So we've kind of break it down into respond, recover, and rebuild. And the purpose of today's webinar really is to provide information for you all, whether it's the economic or investment opportunities and the political situation, how to best maneuver yourselves and put yourself in positions to recover. And hopefully, companies are in varying degrees of recovery and rebuilding. Hopefully most companies by now have responded already, which is kind of the initial hit, which is cash flow management, decrease in revenue, cut down expenses, et cetera. So hopefully by now, most companies are somewhere between recovery and rebuild. And the purpose of today's webinar is really to provide information for you to move from recover to rebuild and looking forward. That's kind of the key today here. We're not going to have obviously all the answers, but we want to be able to provide you, and the panelists have a lot of information to provide to all of you to see how you can think about the next steps as you go through this kind of what we call at GHJ the resiliency journey. So that's kind of the backdrop, kind of the framework for today's webinar, and hopefully you will leave today's webinar with some good information to think about for the next stage of your company. Next slide, please. So to start, we'll kind of look at the general real estate market in terms of the U.S. market as a whole. So for that, I will, Randy, you go ahead and I'll turn it to you to just kind of give a brief summary of kind of the different asset classes, what you've seen, and what you think, kind of the trend is there.
Sure. If you wouldn't mind turning to the next slide. We'll show each of the sectors up here kind of all together. It's interesting. Real estate's been really hit with negative headlines that don't really match reality. The truth is, for high quality institutional real estate, for the most part, and I'll get to the couple of exceptions, have done quite well. Rent collections have been, for the most part, in the 90th percentile, and real estate's held up really well during this downturn. But if you go back and you think about, March, everybody in March said nobody's going to pay their April rent, for example. And then this is on multifamily. Then in April, nobody was going to pay their May rent. And, eventually, we're here 6 months later and everybody continues to pay their rent. But immediately after that headline wasn't really interesting, people sort of switched over to the office market. And they said, you know what, we're going to be in a work from home scenario. Everybody's going to be canceling their leases, and the office market isn't gonna work. And so we've heard a lot of headlines, but the truth is the headlines are starting to flip and the data is starting to come in to show the underlying strength. Now, each of the asset types have been hit in different ways. Some have actually been strengthened, and some of them certainly have taken a little bit of a ding. Some of those dings are short term, some of them are more longer term. Let's talk about ones that have actually been really improving. One that's actually probably got a bump from the downturn is the industrial market. I mean, you think about demand on the industrial side. Well, there's a lot of last mile delivery, a lot of growth in e-commerce. And I won't go through it, but for your edification in the deck, there's a slide showing the correlation between e-commerce and demand for industrial properties. And there's been, already a movement away from sticks and bricks mortar into e-commerce and the adoption thereof. But this pandemic has really accelerated that. In fact, the estimates by some economists are that we've moved 3 years of demand forward in the industrial market that we otherwise wouldn't have received. Think about it from a real simple, logical point of view, is I think about my parents. My parents are now in their 80s. The last thing that they wanted to do was order something on an iPhone or a computer, but they had to. And now that they did it, they like it, and they're permanent adopters. There's additional demand there. That's likely to actually continue and benefit. So industrial's actually done quite well. So of the main property types, it's really sort of fared the best and likely to continue to fare the best for some time. There are some niche sectors that have done really well during this downturn. One of the biggest benefits, or one of the biggest changes in real estate is this whole idea of the combination of the demographics and changes with respect to healthcare and biotech with real estate. So this idea of lab space really makes sense, and different types of medical office that really are linked up to technological advances has actually done really well. Those spaces are full. You go to a market like a Cambridge, or you go to a southern San Francisco, you try to pick that space up, it's higher than it ever was, and it's even hard to get those spaces. Other things as well. We're from home, and if you're worried about working from home, first, you shouldn't be, because if companies can work from home, it means they can operate their business, which means they can pay their rent. But if you don't like the office story in general, know that data centers are actually growing and have done really well during this downturn as well. Cell towers have done really well, whether it's your kids, taking their classes online, or whether it's us, communicating in the way that we're communicating. Those sectors have really benefited from the downturn. The sectors that have been hurt, well, retail. Retail was already having trouble from a sticks and bricks point of view because of e-commerce. Only the best retailers, the fittest retailers, are likely to survive. But don't throw retail completely out. There is a need for retail. There's a need for core retail. And we've seen collections on retail go from the 40s back in May up to the mid 70s today. So it's not that retail is dead or over. It was an acceleration of trends and of retail and retailers that weren't sort of adapting to the times. But that sector has certainly been hit. It's an acceleration of the hit. The other sector that's been hit probably the hardest, of course, is hotel, because travel's really stopped. But there's not really an alternative to travel. And that sector has the ability to both respond quickly to economic growth and also to basically get turned back off. So the fundamentals right now are tough. They're particularly tough when it comes to business travel. So, hotels in New York are very much struggling, for an example. But when we get to a point where hopefully we'll have a vaccine, business travel will make sense again. And people, are making all kinds of comments on the hotel side that we're only going to do, Zoom meetings from now on. People have some Zoom fatigue. And I'll tell you, the first time that your top salesperson loses because they did a Zoom meeting and a competitor X, Y, and Z got on a plane and did a face-to-face meeting in New York City and got the business, believe me, those wholesalers are competitive, those salespersons are competitive, the businesses are competitive, and they'll be back traveling again. So that will recover. Multifamily has done really well. Multifamily historically has been the best performing sector during economic downturns because multifamily is a necessity. You have to live somewhere. Now, sure, there's some challenges when unemployment gets high, but the multifamily that institutions invest in, which is truly investable, are mainly being driven by people that are renting by choice and not necessity, meaning that they have balance sheets, meaning that they're actually doing these kinds of Zoom meetings, they're actually earning income, and we've seen a very strong ability there on the multifamily sector. Now, sure, there's some markets that you can point to that are dramatically hurt in multifamily by the COVID, but growth markets aren't. Markets that, like Florida and Texas and Charlotte and Nashville, where large portions of the population are growing, are actually in really good shape. So, I don't think it's going to be different this time that multifamily emerges as one of the stronger performers during this time. Now, we've also had huge household growth, which we have done in the middle of a shortage of housing. Yes, a lot of people have bought housing, but don't confuse the note that an increase in home ownership necessarily means that you're actually going to have bad performance in multifamily. In fact, for most of history, when home ownership's been going up, so has multifamily. And one quick statistic that I don't think people are aware of, that we have right now the highest in the last couple of decades, number of people between 18 and 29 years old that are living at home. And I know as a parent to people that fit into that category, they don't want to be living at home. So at the right time, they're going to move out and they're going to form households and are more likely to rent as we go forward. The other one I'll mention that I haven't talked about yet is really office. Listen, I've always struggled a little bit with office because it's the most cyclical of the main property types. It tends to have a long construction lead and lag time, and in downturns, you get hit with big broker commissions, you get hit with big CapEx. And when a tenant leaves, it's not like one person moving out of a multifamily building. Maybe it's a whole floor, maybe it's a whole company. Offices in general and the institutional side also do have long leases, so sometimes you can move across these. If you're in a good market with good property types and low levels of leverage, you can kind of stick it across it. There's been a whole lot of talk about the death of the office market. Well, I've heard this comment a long time, and so my hair is long, but it's also pretty gray. First of all, there was articles written back during the .com boom that nobody was ever going to lease another office building, because why would you? Why would you want to be in an expensive market? Why would you not go move out to the middle of nowhere and you can communicate in all these interesting ways that we found? And what they found back then was, for example, firms like IBM sent their people home and they had to call them all back. People couldn't grow their careers, they couldn't get into the culture, they couldn't grow their bonds. Can you imagine going and spending all the money to go into an MBA program, and you want to go and you want to work in New York City because you're working at Goldman, and you want to go have drinks with someone at Barclays, or you want to meet somebody at Jefferies, and you want to grow your business, your Rolodex in your life. You can't replicate that online. Secondly, if you think the headlines were bad for work at home and office, during the .com or today, much worse headlines during 9/11. I was actually working in the New York metropolitan area. People from my neighborhood unfortunately didn't make it home. But nobody thought that they would rebuild downtown New York. Nobody thought that they would, nobody would be in a tall building. It was just too risky, and being in cities were even risky. Well, we fully built out downtown Manhattan. We built the tallest buildings across the world. People are occupying those buildings for the exact reasons that we talked about today. Ultimately, listen, I think that B and C properties where you have back office workers that don't need to be customer facing, I think those things are at risk. And I think technology eventually will drive that demand to a lower point. But over the course of the next few years, you've got two offsetting factors. You have one, some firms will take less office space because they don't need to. They're not customer facing, it's not core to their business. At the same time, when you come back, you're not going to be able to crowd everybody into little tiny cubes where they're on top of each other. You'll need more square footage per worker, as this design shows. And honestly, when you do the math on it, and CBRE put out a nice piece, it almost offsets each other. So you get a little dip, but then when people come back, they're looking for more and more leasable space. And by the time you sort of get through 2021, you're kind of at the same supply and demand imbalance. And I think one of the strongest things that people need to know in real estate today is that, Supply was not out of check going into it. We don't have a lot of new deliveries coming in. It's very hard to get construction financing, whether it's office, whether it's industrial, multifamily. It's got to be a real sponsor with real skin in the game. I mean, heck, even on the office side, a lot of times you have to have office pre-leased to even think about construction loans. The cost of lumber is going up through the roof as well. And what the Fed did in Jackson Hole just last week suggests that they're going to let the economy run hot. And when the economy runs hot, inflation, which is the price almost of everything, is going to go up. It'll keep real estate supply in check and ultimately ought to provide a buffer in terms of supply and demand dynamics. It doesn't mean that we're not without trouble, but the trouble has really hurt the things that were already sort of getting hurt and accelerated it, and hasn't really harmed the things that are the most stable. There's even ways to play this where you can barbell it, where you can invest in things that are beat up like hotels and retail, or you can play into some of the things that are on fire, like industrial opportunities or life sciences or data centers, if you will. But very good supply and demand fundamentals that has stood up in good properties in good markets. High levered properties, value add properties, second tier markets aren't faring as well. And a few gateway markets, because of COVID concerns, the ability to get back to work, like New York City, for example, are also experiencing some challenges.
Thank you, Randy. And so based on, we'll talk about kind of investment opportunities in the next couple
Hey,
sections.
Richard, can I add a couple anecdotal observations?
Yep, of course, Kevin.
To echo Randy's sentiment on the industrial market kind of speaks for itself, and it's been very resilient as a result of a shift to e-commerce. The multifamily side, because we've got a fairly robust multifamily portfolio, we've seen rental declines in some of the major urban markets like New York off 15 points, San Francisco off 10 points. All of that is largely a function of office concentration and office occupancy, which ultimately we believe is going to come back for a couple of reasons that Randy mentioned. Number one, Steve Schwartzman, for instance, from Blackstone, came out in the Journal a month or so ago and said, look, we need our people back at work. We can't onboard people effectively. We can't train people effectively. We can't infuse them with the Blackstone culture unless they're in the office. I want all my people back in the office as soon as possible. You combine that with the secular trend that Randy alluded to, which is we've seen a secular decline in the square footage per worker over the last 20 years. That's going to start to reverse itself. And even in our portfolio, we're starting to redesign space to provide more space per worker. So I don't think there's an offset there. I think when people start getting back to work, even if they decide that, hey, you're going to work from the office 4 days a week and we're going to work from home 1 day a week, you still need office space and you're going to need more of it. So I think it actually bodes well in 2021 and 2022 as it relates to overall office demand. And multifamily, we're seeing very high collection rates across our portfolio. Obviously, it's different depending on the individual market, but we're still collecting 96 or 97% of our program rents. And we've seen a little bit of downdraft in some of the urban markets, but we've seen rates hold pretty steady with respect to some of the growth markets that we're involved in.
Thank you, Kevin. So it's based on from Randy and Kevin's insight here that the death of the office is quite a bit overblown. It may take some time to kind of come back when people are going back to the office, but it's not necessarily the death of the office, so to speak, in the long run. Before we go into just the California outlook quickly, is there one, maybe this is for Randy and maybe Kevin as well, is there one economic statistic or a couple statistics that people should be concerned about in the real estate sector, whether it's unemployment? Interest rate obviously has always been kind of a key component of that real estate market. But what about like unemployment? Is there anything else that people should be concerned about?
Listen, the order of recovery in a real estate market is the same every way. So is the same way that markets unwind. At the end of the day, you have to occupy space because there's economic activity. So you'll see an uptick in GDP, which we probably bottomed out sometime in May. So we'll see the economy start to grow. What follows economic growth then is you start to hire people. Some of the people you start to bring on part-time, like you saw UPS today announcing they're bringing on a whole bunch of people, 37% of which even after the holiday season will become full-time. You move those people into full-time, you crowd them into the space that you have, and the next thing you know, you occupy more space. So generically speaking, always just keep your eye on the fact that if the economy can recover, which it is, we're already starting to see some movement in economic growth. It will mean that then you'll see the unemployment numbers drop, which we're seeing. So we're on that pattern of GDP jobs, and then fundamental space demand. And in the meantime, the thing about real estate that's so interesting is the earnings have been pretty good. Like you look at the public REIT markets because you got contractual durable income in place. It's a little bit mind-blowing to think about how the S&P 500 and NASDAQ that make widgets can be up so much. I mean, how did Apple double? Are people buying 2 times as many Macs? And once you got that second Mac, you're gonna buy a third. But you see earnings per share down in the overall market like 60, 70% by some companies, but yet their stock price is up. On real estate, you haven't seen that big bump, albeit the earnings per share aren't even close to as off because of those durable contractual rents that are in place. But again, focus on GDP and jobs because ultimately creates demand across whatever sector you want to talk about.
Got it. Thanks, thank you, Randy. And Kevin, I saw you on mute.
Yeah, so I would add that it's largely driven by the overall economy and the jobless rate. So you've seen just in the last month, I mean, the unemployment rate was 10.2% in July. The consensus for August was 9.8%. It came in at 8.4%. So just the fact that you're seeing that kind of break, if you will, in the economy and the jobless rate is all going to be very positive. It'll be interesting to see, given with the trend in the last month, how the government reacts with respect to the next stimulus package and whether or not they feel it's compelled to layer as much into the next round of stimulus as they originally anticipated. And interest rates for being low for longer periods of time, I think also creates a little bit more price support for real assets.
I'll save it for later because I know you and Dan are political junkies, but a little bit of what happens politically on when these things get passed and the fact that real estate's largely been left out of any stimulus type program probably has a lot to do from a political point of view. I'll leave that for you guys later in the program to kick around.
Sure. Yep. And then before we move on to kind of the actually great segue into political environments, before we move on there is kind of what about California outlook? And maybe Kevin, this you can touch on since you're so well in tune with California. Like a lot of our clients are still very invested in California. So what does it look like for California? I mean, for the next 12 months.
That's a great picture that you throw up, the fact that there's a conflagration in the background. Like, it's a good way to start. The fires that are occurring out there, the more they encroach, is going to ultimately improve the outlook for single family housing because they all have to be rebuilt. But I tell you that to me, the California economy starts with the federal government, and right now we're in a classic bid-ask spread between the Republicans and the Democrats with respect to the next level of government stimulus. I think last I checked, the Dems have offered up $500 billion on top of the $350 that has not been spent from the last round. They were previously thought that they could settle at about $1.3 trillion. The Democrats are at $3 trillion. They came out and said, we think we can settle at $2.25 trillion. So they're only $1 trillion apart, which what's $1 trillion between friends? Goldman Sachs came out yesterday and said, yeah, we think they're going to settle at about $1.5 billion. So Goldman Sachs is opting, they believe that they're going to split the proverbial baby. And then the other question is, when is that going to happen? And is it going to happen soon into this congressional session? Or is it going to really kind of lap into the end of September? By the end of September, we actually have to approve the federal spending level. So the hope and expectation is that they can get their proverbial act together, approve the temporary spending level, and infuse the economic stimulus as well, which we feel most of that in the multifamily sector to the extent that you can increase the unemployment benefits greater than what the individuals would otherwise be entitled to, really bodes well for the multifamily sector across our platform. And then in terms of in California, just from the political landscape in California, I think that California is doing everything possible to try and drive as many people out of the state as they possibly can. So I know you wanted to talk about some of the other proposals, 15 and 19 that are out there. The split roll, which to me I think is going to have a materially negative impact on valuations. If Biden gets elected, increasing the federal rate from 37 to 39.6, removing the 1031 exchange, all of which is going to bode negative, particularly for California, because California has been a huge driver of 1031 exchange activity, which is still a very small percentage of the overall transactional velocity in the marketplace. What concerns me a little bit more about California is all this noise about just taxing the rich, and that's the path to righteousness. Just keep taxing the rich, and we can kind of work ourselves out of the economic bind that we're in. Well, last I checked, the top 1% of Californians pay almost half of the income taxes. The top 5% pay 2/3 of the taxes. But that notwithstanding, February rolls around and Assembly Bill 1253 comes out where they say, hey, you know what? We think this COVID thing and other negative impacts across the economy in California are going to have create a bigger budget gap. So why don't we tax those that make over 1.2 million, another 1%. We'll kind of gear it up to once you make over 5.9 million, we'll tack on another 3.5 points of taxes. And we're already paying, if you're making over $1 million, you're already paying 13.3%. So could you imagine the impact of having to pay at the margin 16.8% California state taxes? I got to tell you, I was fortunate enough to have spent 6 weeks at our home in Sun Valley, Idaho, which has been just crowded by Californians from the Bay Area and from Los Angeles. And while we're there in the middle of August, some numbnut, approached or proposed the Assembly Bill 2088, which on top of 1253 adds another 4% wealth tax if you've got over $30 million. So just keep taxing the rich and we'll see what happens. I can tell you just on my social interactions in Sun Valley, I've never been up there, and I've been going up there for 22 or 23 years. I've never been more engaged in more frequent conversations about Californians that want to get the hell out of California and move to Idaho, which by the way is not cheap. I mean, Idaho itself has got 6.9% marginal tax rate at the top end. But the idea that they can save 10 points, what has happened over the summer is you've seen more single family investment activity or acquisition activity this past summer than we've seen up there in the last 20 years. The one private golf course up there that's had an overhang of memberships for the 20 years it's been around, completely full over the summer. So Californians are looking for ways to come in droves to move to Idaho. You're probably starting to see the same thing in Nevada and Texas, Jackson Hole, Wyoming, anywhere where there's a very robust second home community that you've seen an unbelievable amount of activity. So all of that to me bodes particularly poorly for California, not just the single family market, the multifamily market, the office market, anything really other than the industrial market is going to suffer if the political headwinds continue to stay in our face.
Yeah, no, Kevin, you bring up this kind of great segue into the next current political environment. And for those, and we actually got a Q&A question on this already, talking about what's the potential impact of Prop 15 that's going to be on the ballot for California. So for those of you who may not be aware of this, that our firm, we have a state and local principal, Francis Ellington, in our group that actually put out a great blog article out on our website talking about Proposition 15 and 19 actually. Which is going to be on the upcoming California ballot in November. And the main one is going to be Prop 15. That's a big one. I mean, if it passes, it creates quite the change in the way property tax is assessed on commercial and industrial properties. Basically, you have an initial valuation back to fair market at the time of, and then every 3 years you revalue after that. And it's going to be applicable to property in the aggregate worth over $3 million, right? So that's going to be a big deal and a big change to the historical Prop 13 that we're all very used to, whereas you're kind of based on your cost basis or purchase price, and over years go up a little bit every 2% or so throughout the year. So that's going to be a big change. So, in terms of just the political environment, what about at a kind of a national level? I mean, is there anything that you see? It could be the 2020 election that's coming up. We are in a very unique year where we are in an election year with COVID all happening together. Is there anything that you see maybe is something that needs to be, people need to be concerned about or consider? There's a lot of political noise, a lot of theater, so to speak, during election years. Is there anything that actually matters or very important to people to keep an eye on?
I'd like to make one comment on Prop 15 and the split roll concept. In California, we're used to having to negotiate leases with Prop 13 protection with our tenants, particularly if we've got large single tenant transactions. It'll be interesting to see how the tenants react to Prop 15 increases and whether or not we've got to start as a landlord providing Prop 15 protection so it doesn't get factored into the expense basis, and whether or not we can pass that through to the tenants. To the extent that we can pass it through to the tenant, if we can't pass it through to the tenants, it's going to have a negative impact on value. And if we can pass it through to tenants, depending on the extent to which we can, it's going to have a negative impact on the tenant base and just make California a less viable and attractive place to locate your business. So you're going to get it on both sides, right? You're pushing out the those at the top end of the earnings cycle just by virtue of the fact that you're continuing to tax the rich, and you're making it less business friendly from a tenant perspective to the extent that you're going to increase taxes and increase their operating costs to run a business. I mean, occupancy costs is one outside of labor is the largest single expense in running an operating business. So I think all of these things are going to operate negatively to have a negative impact on California real estate values. And then if Biden's elected, I mean, there hasn't been any real noise around Trump and his propensity to predilection to raise taxes, and he's probably more inclined to go the other way, as he did in 2017. But Biden comes in, removes the 1031 exchange, hikes the federal rate another 2 or 3 points, phases out the qualified business income tax deduction, eliminates the basis step up for inherited assets, which I find just astounding. I love the idea that I got to pay taxes twice on the same assets, much like I feel so positive about the imposition of a wealth tax. And are we going to have a wealth tax imposed at the federal level too? I'm certainly they've been having those kind of conversations. Ending capital gains for those that make over $1 million. I mean, as we sit here in California today, there is no capital gains tax break. So it's just one thing right after another. Lower the estate tax exemption from 11.6 million back to $5 million. It's just more and more and more. I mean, by the time we're done, I think I'm going to be paying about 60% on the margin, not even including the sales tax of 7.25% and the property taxes we're paying in California. Other than that, were it not for the fact that my wife and 3 of our 4 children and our 2 grandchildren are all living in California, I suggested to my wife over the summer that we too move to Idaho. And she suggested, given her deep roots into this community, that if I were to make that move, I'd be making it alone. And I think my response was, be careful what you ask for. Fortunately, California makes it exceedingly difficult to actually change your state of residence.
Yeah. With all that information now, with kind of the overall outlook, and we do want to have some time to get into the kind of transactional with Dan. Before we move on, just a quick
real quick, if I could, Richard, before we transition.
Yep, go ahead.
Well, a couple of thoughts as to what Kevin said. And I agree with what Randy's articulated and what Kevin has, as usual, so candidly presented for us. A couple additional points to think about. First and foremost, it is difficult to change residency out of California, but it's not impossible.
Yep.
So do keep that in mind. There are ways to make that happen if you're willing to really go through what is appropriate under the law to make that happen, and add a delta that in some businesses actually changes profitable to unprofitable transactions. I think people are going to think about it, and it should give people pause from a business perspective. Second, from the federal legislative changes that are being talked about, this is the midst of an election cycle. And our country has a history of allowing candidates broad latitude to make significant promises to anyone who asks for anything during this moment in time. I believe a more soft and thoughtful approach will happen regardless of what results for the presidential election, the Senate, or the House. We're in difficult times right now, but there still are a sufficient number of thoughtful moderates who are going to try and adopt a balanced tax policy that the litany of things we're seeing tossed in front of our taxpayers today will not all land. And hopefully we return to more thoughtful times post-election process. So we have a right to be concerned, but the elections in and of themselves are going to be the end of the discussion.
Yeah.
I mean, I think the good news is because the economy still has a lot of fragility, the idea that they can adopt any of this in any swift fashion, even if Biden is elected president, it'll take a couple of years to actually mobilize the resources to actually implement some of these changes. So we got maybe a 2-year runway before things really start to hit the fan. You know, what's interesting, and I was reading an article about this yesterday, is the whole hoopla about the election and the mail-in ballots and when and if you can count those mail-in ballots and how many of those are going to be kicked out as a result of bad signatures or no signatures is going to likely create a scenario. Well, first of all, we're not going to know anywhere near November 3rd who our next president is going to be. And then it's the question of how long it's going to take to count all those absentee ballots, whether or not they're going to count, how many lawsuits that's going to bag. And I think if we haven't decided who the next president is by, I think it's January 20th, then the Speaker of the House becomes the president. So Nancy Pelosi could actually be our next president if we can't get our proverbial act together between November 3rd and January 20th. Think about that.
Yeah. You know, with all this information and, you know, kind of financial metrics and the political kind of news and environment and where, before we go to Dan, just briefly, quickly, in terms of if you were, you know, investing now, if you're holding investments or you're looking at new investments, where would you, I mean, what kind of asset class would you go into, first of all? And if you're still in California, what, is there any place in California, what kind of asset class in California that's worth looking at?
So I would tell you that it's a good question. Everybody wants to invest into an economic recovery. The problem is the generic financial assets have already recovered and then some, and it makes no sense. When we started in January of 2020, the S&P 500 was already trading at PE ratios that didn't really make any sense given where we were in the economic cycle. Here we are, we go through a pandemic, earnings per share are down, and we're hitting new highs almost every day. Now, we're starting to see some of that unravel. When I look at it, and I look at investing today in the generic stock market, you historically would receive over the next 5 years a return of about zero. You're doing the equivalent of just buying high. And a lot of that's happening because people don't really know where to put their money. You've got more people on Robinhood than ever. They're taking their stimulus checks and putting it into the market, and you're getting things that don't really make sense. People are literally sort of gambling there. It's tough to think that's a good new dollar. A lot of people also look at the bond market. If you look at ag bond, you know, it was nice when you could make 4 or 5% on it, but the truth is the prices have been bid up so much, some because of federal government support, some because of a flight to safety, and all of a sudden bonds are trading, you know, the PAR's 100, they're trading at like 110, 111. Your yield the worst, which kind of the yield that you would expect on these securities if you hold them to maturity or they get called, is barely 1%. So, you know, if you think interest rates are going to rise, you got 6 years duration, there's almost no way you can make money with a fixed income security. It's tough to think about making money in the equity markets. You got to look elsewhere. And that's why I think things like real estate, for example, do make a lot of sense. I think that the fundamentals are strong, but because of all the bad headlines and the people on Robinhood, take a look at the REIT market, and we'll show you a slide on that in a minute. But the REIT market, RMZ is like an index of the REIT market. It was at 1360 at one time. It's at 1,050. It got a little bit of a bump from the bottom, but it's been flat. Why? Because it's neither fish nor fowl. It's not like Hertz that's going out of business or Carnival Cruise, so I'm going to take a flyer on it, but it's also not your work from home stocks that people thought would go to the moon forever. So these defensive, strong contractual companies that are in good shape that have been overlooked. So if you want to look into the recovery, a way to do it with a stable company and not sort of gambling on companies, you know, really fully in the eye of the storm, is to take a look at some investments outside of your traditional 60-40 type opportunity.
Great. Next slide, please. And then I'll bring up the slide that Andy was mentioning.
Yeah, I mean, that's kind of my point. I don't know if everybody can see. I've got the panel up. But, you know, this basically looks at yields on real estate relative to the 10-year Treasury. And remember, before the last downturn, people bet that real estate would be all growth. So the truth is, you could get higher yields in many cases on a government security than you could on a risky asset, which didn't make sense. It means your total return, if it's income and growth, you've given up income. You're assuming that real estate should all be growth, and real estate's an income vehicle. Well, if you could see it, kind of, we were starting to get to where real estate was pricey over the last year until the Fed stepped in and naturally widened the risk premium again. So the spread between what you get on real estate, I mean, shoot, core real estate at 4.5 looks really attractive to a 70 basis point 10-year Treasury. It doesn't look so attractive when the Treasury, everybody said it was going to go to 3. I remember Jamie Dimon on TV a year and a half ago saying it was going to 6. So people were worried about real estate because the spread between what you could get and the interest rate in the market or the alternative things that you could search for income presented no opportunity. Today it looks pretty good. So there's no real reason for cap rates to rise, hurting value, because this asset's going to look relatively attractive. If you flip to the next slide, you can take a look at the public market. And you can see there, if you look in the left-hand column, the spread between REIT dividends and the current dividends are, 380. So you kind of look down there in the column between 325 and 450, you can see the returns that follow, meaning that spreads are wide by historical standards. You're getting a lot of yield from real estate relative to what you can get in the fixed income market. You're generally speaking, you're talking about mid-20s to 30% kind of returns on a go-forward basis, meaning that the real estate market on the public side, is certainly not at all-time highs and hitting records every day, but yet it's sitting in a very strong place based on historical standards. So from my point of view, it's a good entry point on real estate. I think it's very hard when you walk through every other asset class to start thinking about having a great entry point. There are a few things in alternative credit, which is beyond the scope of this discussion because it's real estate, that makes sense. But you start going across the asset classes that are traditional, you go, well, I don't know. I'm investing high. It doesn't seem like a great place to be. It's time to be diversified and cautious.
Yeah, thank you, Randy. And that's all really. It seems like real estate is a great place to be in. And how do people get in? I mean, and this is kind of what I want to turn to Dan on, is some of these structuring and investment vehicles. So, Dan, I'll let you take it away and let you talk about the DSTs and the qualified opportunity zone. Just kind of give a brief kind of overview for some of these two vehicles and DSTs, and for those that are on the call may not be familiar with these.
Yeah, I'd be happy to do so, Richard. When you look at the two factors that both Randy and Kevin have outlined so far, one possibility that could result is the following. There was an expectation of a material decrease in certain asset classes valuation, which would cause people to hold on to that asset and not want to transact. However, in many circumstances, that hasn't occurred. Randy listed numerous of those examples, including multifamily and other. At the same time, you do have within the state level and potentially at the federal level, increases that people see on the horizon from a tax exposure. Whether they'll be moderate, as I predict, or more extreme remains an unknown. When you look at those two factors creating pressure together, there's going to be the reality that between the last quarter of 2020 and the first quarter of 2021, people are going to start to transact to where they're going to want to either exchange assets from one jurisdiction into the other jurisdiction, or take their gains at valuations that they think they can get today and roll them over into other income producing type assets. In those circumstances, where a taxpayer is looking to redeploy the built-in gains that they're harvesting, there are two things that they need to be talking to their accounting firm and their tax advisor and their legal team about. Now, in many cases, one of the best courses of action would be to pay the tax and reinvesting an asset at the full stepped up basis and get the offset from that depreciation against the cash flow. Let me pause and state that. An analysis should always be done, whether or not your best path is to pay the tax, right? And this is a tax counsel telling you so. To pay the tax, take that after-tax proceeds, buy an asset with a full stepped up in basis, and offset cash flow from that asset with the depreciation and or interest rate deductions. In some cases, that may be your best path. In many cases, however, due to depreciation, ordinary income recapture, you may want to avoid paying the income tax at capital gain rates and ordinary income tax rates in some circumstances on the asset you've sold. We usually call that the relinquished property. In those circumstances, there are two things that you should think about. If it is real estate and only real estate to the majority extent, you should think about a Section 1031 like-kind exchange. At its base case, Section 1031 like-kind exchanges mean nothing more than the following. From a policy perspective, the government has decided it is not yet time to tax you. You have a continuity of your investment. You have not achieved sufficient liquidity so that the government should take its share. And in that case, where you've gone from one asset into a like-kind asset, assuming you've met all the technical requirements, you should be able to avoid paying tax today, take a carryover tax basis in the replacement asset, and move forward with no tax until a subsequent disposition in the future. Now, Section 1031 in the last major tax reform act was limited. At one point in time, Section 1031 applied to virtually any asset except for assets held in inventory. Today, Section 1031 only applies to real estate. Although I believed then and believe today that was a mistake, I'm happy that they have protected Section 1031 for real estate purposes. Removing Section 1031 for real estate purposes would have a major impact on the real estate industry at large, particularly during a time when we're concerned about employment impacts. And moreover, it would have a devastating impact on people's desire to transact, as I mentioned earlier. So if you're thinking about a disposition between the end of 2020 or at any time in 2021, you need to think about a Section 1031 like-kind exchange. Now, the key factor that I've mentioned in there is the phrase like kind. It sounds simple, and from a policy perspective, it's drafted to be simple in that like kind in real estate is defined incredibly broad. An investment property in Manhattan is like kind to certain oil and gas interests of minerals in place in Texas. So it truly is a broad definition. The practical realities, however, are quite constraining. The ability to stick the landing of disposing of your relinquished property and finding a desirable replacement property is very, very hard in the friction-filled world in which we transact business in. In such circumstances, there are companies that will put together real estate opportunities on a packaged basis to help alleviate that tension. I know Griffin Capital has been incredibly active with high-class investment real estate assets for such Section 1031 replacement property options, as well as other clients. We've worked with Griffin on these transactions for several decades now and have been very pleased with what we've been able to see. Now, Section 1031 is limited to just real estate capital gains. If you have capital gains from other assets, the second thing you're going to want to keep in mind, and Richard, if you wouldn't mind advancing the
next slide, please.
detailed slides that I presented
To
for you, all the way to the QOZ slides, any other capital you might have during these times, right? The same dynamic where you're going to harvest a capital gain based on what we're seeing in the marketplace outside of the real estate or inclusive of the real estate sector. You may be willing to think about, okay, I do not need that liquid cash today. I still want to continue an investment, but just not have it be a like-kind investment. Then virtually any capital gain, right? Whether it's a capital gain from the disposition of real estate, or frankly, the capital gain component of your REIT dividend, right? Any capital gain that you can identify, if you wish to defer that gain for a period of time and invest it in a structure where in the future you have the opportunity to potentially being the most important point there, to potentially eliminate future gains, then you should think about qualified opportunity zone investments. Those investments can be structured as a captive investment in which you control the totality of it, as a joint venture with other parties, or as part of a fund investment offered by a large fund manager. Again, Griffin Capital offers such an investment opportunity in their qualified opportunity zone fund. Now in that case, once you have given rise to the transaction of the relinquished property and harvested your capital gains, you have 180 days to invest a dollar amount of any type of capital gain into a qualified opportunity zone fund. If you do so, that built-in gain from your relinquished property will not be due until after December 31st, 2026. So you have a deferral opportunity. Second, if you do so between now and the end of the year and invest in a timely manner, you could also get a reduction up to 10% of the amount due on the gain you otherwise would have recognized in your relinquished property. Then what you have the opportunity to do is invest your what otherwise would have been after-tax dollars, as well as the dollars that you would have handed over to the government as your tax, and invest both of those pools of money into the Qualified Opportunity Zone Fund. So right there you have an increased ability to upsize the amount of your investment. If you're willing and able to hold that Qualified Opportunity Zone Fund investment for a period of 10 years, right? That's a hard, long time to hold that investment. But if you're able to do so, at that point in time, after 10 years, on the disposition of the entity interest or the underlying assets, if structured properly, you will get a fair market value step up in basis. It's a fancy way of a tax lawyer saying you can eliminate the built-in gain that could accrue during that 10-year period. Usually, you only get the opportunity to have a fair market value step up in basis. Either A, pay the tax, B, die, or C, properly value yourself to a qualified opportunity zone interest. Yep. Of those three opportunities, qualified opportunity zone interest looks pretty good. Now, both of those structures can be unduly complexed. And so it's important for you to do advanced planning and leave yourself sufficient runway so that you can properly execute on either of those types of investment structures. So I'll pause there, Richard, and see if there's any specific questions you would like me to address.
No, I think that's, you kind of hit it really well, Dan. I think there's a lot of stuff to, go over and think about with these investment vehicles, which I'm going to kind of leave at that for now, in terms of what people should think about. But people shouldn't be aware of these vehicles. But I do want to kind of mention two things. And for Q&A, we have 4 minutes left. So we have one question that came in with the slide presentation being made available. It will be made available. And that's, we will circulate that. In terms of just quickly, Dan, if you can name barriers of entry for these two type of vehicles, what would they be? What would be the main barrier of entry where people that may want to get in but might not be able to get in?
Yeah, so the first main barrier of entry is Section 1031 like-kind exchanges are an immense amount of congressional grace, right? You really get to avoid to pay your tax and roll it over into another asset that you could hold for a very, very long period of time, right? Unlike a QZ structure where you end up having to pay that tax after December 31, 2026, with a Section 1031 exchange, you could defer that tax indefinitely. And if you defer it till the matriarch or patriarch passes away and get a step up in basis, you actually can eliminate the tax in a Section 1031 context as well. The problem is the window to stick the landing on the transaction is too narrow, in my view, right? Under Section 1031, you need to, within 45 days of the sale of your relinquished property, identify properly under certain complex rules, replacement property. Once you've identified that replacement property or properties, you have to close on that property. You must close on that property within a 180-day period. Sounds simple enough from a day counting perspective, but anybody active in the real estate business knows closing on a specific date can be hard.
Yeah.
Every transaction seems to get extended or delayed. Different circumstances arise in due diligence where you actually decide you don't want to buy that particular property. So having the ability in a more fluid market to have backup properties that you identify is essential. So it's the timing pressure requirement under Section 1031 that is the most difficult. Syndicated Delaware statutory trusts, tenancy in common, and other triple net lease structures are available to help alleviate that difficulty.
Yeah.
From a QZ perspective.
I would add there, Dan, for a second. If you go the securitized route, the other barrier to entry is because of the Reg D offerings, you have to be either an accredited investor or a qualified investor or qualified purchaser. So at a minimum, you have to have at least $1 million net worth exclusive of your residence and other personal property.
Yeah. No, I think all of that is great information. I know we have just a minute left, so we'll have to end our webinar for today, but we have all the contact information in the back, along with the firm, Randy, Kevin, Dan's firm, and their background, their information. So I know we have a couple questions we couldn't quite get to, but we will be sure to address after the event, and then we'll be circulating the presentation so that you have all the slides, and if there's any information, you can feel free to reach out. And I just want to take this time also to thank Randy, Kevin, and Dan for spending this time. We went through a lot of information. An hour wasn't quite enough, but we were hoping that we can cover as much ground as we can and provide you with important and essential information as you move on to your next recover and rebuild phase. So I do want to give my appreciation to the three panelists on board today. And so we'll end it at that, and hope you guys all stay well and stay safe. And thanks again for attending.
Thanks for inviting us, Richard. It's a pleasure.
Thank you, everybody. Thank you, Richard.
Yeah, thank you, everybody.